Welcome to GEPL Capital Talks on Tuesday, a weekly podcast, bringing to you an interesting talk related to finance every week. Stay tuned. Subscribe now and press the bell icon to GEPL Capital's YouTube channel and never miss out on any stock market update and build your knowledge on investment. Hello and hi everyone, and welcome to our Talks on Tuesday's weekly podcast. This is our episode number 55, and today we have with us yet again Hetika, who is certified financial planner, having experience of 4 years. Today she will be giving us 3 tips on asset allocation in your 30s. Hi Hetika.
Hi Lakshmi.
Please tell our podcast listeners what is asset allocation.
You know, Lakshmi, financial markets has made asset allocation a very complicated term. But if you see, asset allocation is a very simple thing. Let's take an example of a street vendor. You all must have seen a street vendor, right? He sells different things, like in this example, sunglasses and umbrellas. If you notice, nobody will ever buy sunglasses and umbrellas both at the same time. In monsoon, people buy umbrellas, and during summers, people buy sunglasses. But still, he keeps both so that no such day comes where he can't sell anything. Now, this is asset allocation. Which asset will work when nobody knows? Your portfolio allocation should be there in different asset classes.
Hetika, can you tell our investors 3 important tips on asset allocation as per you one should follow when he or she is in their 30s?
Sure, Lakshmi. I'll tell you 3 important tips you must follow when you are in your 30s. But before that, please note, before investing your money in different asset class, check if you have taken your insurance, as this is a mandatory step. If you haven't taken your life and health insurance, then please get your insurance done first. Now, coming to the 3 important tips you must follow. Tip number 1. First and foremost, set aside at least 3 to 4 months' salary as emergency funds. Allocate this money in liquid funds to avoid any unforeseen events. This is a very important part of asset allocation. And trust me, this has been neglected by more than 70% of investors. Tip number 2. Diversify your investments in different asset class, mainly in equity, bonds, and gold. Equity mainly helps in long-term growth, for example, buying a house, family planning, etc. To start with, you can always follow a thumb rule to find your equity allocation as per your age. That is 100 minus age of the investor. For example, if you're 30 years old, you can invest 30% in debt and 70% in equity. Bonds or fixed income gives you stability as well as liquidity. If you have short-term goals like buying a phone or a television or a short trip nearby, you should prefer investing in debt funds. Gold generally acts as a hedge in any unforeseen events. Tip number 3. This is a very important tip you can't ignore. That is allocating a part of money in tax saving instruments. Use instruments that not only help you save tax but also build wealth over a long term. As tax saving instruments have a lock in period, you should invest for long term goals in these instruments.
Thank you, Hetika, for this 3 important tips. And can you give us an example of 30 years old having a total surplus of 6 lakhs?
Why not, Lakshmi? Let's take an example. If you are 30 years old and having an investable income of 6 lakhs, that is after excluding your insurance and day to day expenses, the first step you will keep aside at least 3 to 4 months of salary as emergency funds. So, in this example, you will keep roughly around 1,20,000 as emergency funds. After keeping this aside, your insurance, day to day expenses, and emergency funds are taken care of. Then comes your asset allocation. In this example, the remaining balance, that is 4,80,000, you can allocate in large cap, mid cap, small cap, and tax saving instruments. Under tax saving instruments, the premium paid for a life insurance premium is eligible for a deduction up to 1,50,000 rupees under Section 80C. Assume if you have paid 40,000 for a life insurance premium, then remaining 1,10,000 you can invest either in PPF, that is Public Provident Fund, or ELSS, that is Equity Linked Savings Scheme. If you're looking for a long-term debt instrument, PPF is a more tax-saving option. And if you're looking for a long-term equity instrument, then ELSS is more of a tax-efficient option. Based on your risk tolerance, whether you are a conservative investor, moderate investor, or an aggressive investor, you can consider this allocation, which is reflecting on your screen.
Okay, Hetika, what is the last one advice you want to address to all our young investors?
Last advice. Okay. Since you're all in your 30s, you will have many goals to achieve, which are a mix of personal and financial goals. One thing you shouldn't forget is making investing a regular habit by using tools like ECS, that is bank mandate, which allows you to deduct money automatically from your bank account on a specified date of the month, also properly popularly known as systematic investment plan, that is SIP. Remember, if you save after spending, you will never be able to save enough. Instead, try to spend whatever is left after saving. As your income grows, increase your savings. Thank you.
Thank you so much, Hetika. I hope this was an informative podcast for you all. The topic for the next week talks on Tuesday will be top 3 banking stocks to invest. Hope to see you then. And don't forget to press the bell icon and subscribe on YouTube. And also follow us on Instagram and Twitter for where we will try and make investing simple for you all. Thank you.